Thank you very much, Tim, and thank you everybody for taking a little bit of time to listen to my very brief update on the agency real estate group. Tim mentioned, my name is Geoff Lucas. I'm the group CEO, and I've been in this role for 6 months. Prior to this, I was the CEO at McGrath, which is a similar company in a similar space, but I'll run through the differences that our particular business model has to the vast majority of the industry. The reason I'm here is because I saw that the founders of this business came up with a vision and a model that was different. And we think tailored to what the needs of customers and agents are going to be moving forward into the future in this rapidly changing environment. So let me just walk through these slides very briefly, and hopefully we'll get some time for some questions afterwards. Thanks, Tim. We'd like to start with this to talk about the size of the industry. I'm excited about working in this industry because it's a big industry. Up the top there, you'll see that the assets in this industry are worth $8.9 trillion. Now that's grown significantly over just the last couple of years. It was circa 6.5 to 7 trillion just 24 months ago. But the rate of change is interesting. The most interesting thing is, I guess, the relativity of size of this asset class. You'll see on the right-hand side here at 8.9 trillion, we're some 3 times the entire Australian superannuation industry, and also some 3 and a bit times the ASX as a whole. Compared to the commercial real estate industry in Australia, we're a staggering 9 times the size of that. So what does that mean for us and for you as investors or potential investors? Well, it's the total addressable market that we're after. Really, that's the commission income that comes from the sale of these houses. We had about 600,000 sales in the last 12 months, as you'll see in the hexagons on the left, and that generated a gross value of approximately $411 billion. If you multiply that by the average commission rate of 1.3%, now that's not the commission rate in the markets that we generally operate in. We're generally between 1.7 and 2%. The Australian National is somewhere around 1.3%. That gives a total fee pool, commission pool, or total addressable market of $5.3 billion. That's what we are looking to gain an increased share of. Currently, the business has been in existence for just over 4.5 years, and we currently account for just short of 1% of the market share. Now, to put that in perspective, highly fragmented industry, which also gives us cause for great excitement, for opportunities for consolidation and growth in market share. Ray White, probably the market leader, some 800 to 900 offices currently, probably about 9.5% market share. Then it falls away very quickly. The numbers 2, 3, and 4, people like Bell Property, LJ Hooker, Rain and Horne McGrath, each having somewhere between 2 and 3% of market share. So sitting just short of 1%. And with the executive team I've got here that I've worked with before in gaining market share, we're quite confident of gaining increased share in coming periods. Thanks, Tim. So this slide, a lot of information there, but basically in a nutshell, it's talking about why we differ, and I'll quickly walk you through that. You can read that at your own leisure. The Australian industry has predominantly been populated by franchise businesses, Rain and Horne, Ray White, LJ Hooker, and the like. That's the vast majority. So small businesses, franchisee businesses. In that value chain, you've got the group up here, the Ray White Group, for example. Then you've got a franchisee here and then underneath the franchisee, you've got the real estate agents who generate the commission. The franchisee, they take a leakage of value out of that value chain, and they're entitled to it because they've invested their time, effort, intellectual property, entrepreneurial skills, etc., and they take a leakage of that value. We've removed the franchisee. So we go directly from the agency to the agent, and to both us, but also the agent. So we're able to pass on higher splits of the commission, and I'll show you a chart in a moment, higher splits of commission to agents. Agents are attracted to that, hence the attractiveness of our model. The other thing with our business model is we don't believe in retail offices. We don't think people go to real estate offices anymore to transact property. They do it largely here. They do it face-to-face in the marketplace. Moreover, we operate what we call hubs, and we've got 6 of those around Australia at the moment. And those hubs are not street front, and they don't have $1 million fit outs, and they don't have glossy brands all over them, but they're highly functional and appropriate facilities for our agents to come, have their sales meetings, collaborate, and then disseminate out into their respective marketplaces. We think that's the future of how real estate businesses will operate in the future. And that's been exacerbated by COVID, and we've seen more and more. I mean, the industry during COVID has been really hardly even lost a beat. And we think that that's actually accelerated that style of doing business. Stabilised our balance sheet, and I'll talk about that a little bit later. We're a vertically integrated business. We see some 500,000 plus people face-to-face at our open for inspections across the country every year. So we figure that it's an opportunity to actually offer those people who are buying and selling property ancillary or adjacent services. And to that end, we have businesses that accommodate mortgage broking, settlements, also property management, and also conveyancing services. So we're starting to provide ancillary or adjacent services, and we see great opportunity to broaden those and to offer further adjacent services as well. We've had some strong macroeconomic tailwinds, notwithstanding the challenges of COVID. We've had low interest rates. We've had limited stock on the market. We've therefore had high prices. And we've seen days on market come down so that the industry has increased the number of transactions in the last 12 months by about 40%, notwithstanding COVID. We've built the business nationally. That's quite unique. We've got a very scalable footprint, and we're currently operating in Western Australia, New South Wales, Victoria, and Queensland, looking to grow the states, but also looking to grow our market share within those states. Thanks, Tim. This slide here just really highlights what I was speaking about before. Over on the left-hand side, you'll see the traditional franchise model. The vast majority of the Australian industry is structured this way. The franchisor takes 10%, the franchisee left with about 40% to pay the costs of their offices, etc. And the agent generally takes 50 to 55% of the take. Across on the right-hand side, independent operations. Again, the principal in their expensive offices takes 40% and the agent has 60%. In the middle is the agency. Now, we're an agent-centric services business. So you'll see there that the agents in our business take a split between 65 and 85%. We're able to do that because of the model that I discussed before. We're also able, through our scale, to offer very efficient, effective back-end services. So we make sure that the agents are out there doing the things that they should be doing. They're salespeople, and we look after an efficient back end for them. Thanks, Tim. How did we go last year, financial year 21? It was an exceptional year for us. Now, we're not here to generate an EBITDA annually of $4.6 million, but it was important because it's only in the fourth year of the operation of the business. And we built a scalable business, so there's significant infrastructure there, and the revenue needs to cover those costs. Last year was important because we actually did that and had some surplus, and so we're in momentum, and you'll see that with some of the other numbers. So the benefit there is as we continue to grow, and we should continue to grow and attract more agents and grow more market share from our current 1%, more of that return will drop through to the bottom line. And we've seen that in our reducing operating expenses as a percentage of income steadily over the last 3 years. Our GCI, that's the total of the commissions that are earned by our agents that work with us, up 69% on the prior year. Our growth compared to market, I mentioned before, the market grew strongly in terms of numbers of transactions, 40.7%. Not everybody will tell you that because they're busy talking about how they grew, etc. That's terrific, but what we're concentrating on is outperformance of market. That's how we grow our market share. We did 57.7% uplift in transaction numbers, about a 30-odd% increase over the market rate of increase. Worked really hard, and there's a slide coming up on our balance sheet, and we're now in a really strong financial position to go forward and take opportunities as they come to us. Thanks, Tim. Again, this slide here just reiterates the fact that we had 4,964 transactions last year, which was 57% up. We've got the platform. We're ready to now scale further. Thanks, Tim. This is the national footprint that we've got. You'll see that we've got, this is our agent distribution. We've got 155 in WA. We've got 144 in New South Wales, 21 in Victoria, just 9 in Queensland. Queensland, we opened 3 months ago, and we're seeing exceptional rate of growth up there as we speak. So that's the way that we're distributed at the moment and looking for growth in all of those key markets going forward. You'll see up the top the agent numbers, fairly steady growth, 308 to 329 there on that bar chart. We're up about 7% since the 30th of June on that 308 So we're growing quite well, and that's validating the attractiveness of our model. Thank you, Tim. This is the chart I mentioned to you in terms of balance sheet repair. Just 2 years ago, you'll see on the right-hand side that we had debt of $21.1 million. And that was debt that was accumulated from the initial startup of the business and buying some assets, rent rolls, etc. Companies worked very hard in reducing that, and you'll see the trajectory of that versus our EBITDA. We had negative $4.2 million in that year. Now that trajectory has improved significantly, and you'll see in FY21, we've narrowed that down to $8.35 million in debt and against a $4.6 million EBITDA. That trajectory, certainly of the EBITDA, we like and will continue to work on. We think that it's useful and efficient to have a modicum of debt, and perhaps that's circa $5 to $8 million going forward. It's backed by assets of about $25 to $26 million. Thank you, Tim. So what are we seeing at the moment? We're seeing at the moment pretty strong pipeline of listings. Post-COVID, there's a lot of positivity, and we're seeing lead indicators like comparative market analyses that agents are requesting through CoreLogic. They're starting to lift, and that's a lead indicator for more property coming on the market. What does that mean? Probably demand and supply moving more toward equilibrium. Good thing for steadying price growth. That can't go on forever. Good thing also for numbers of transactions, because we see a slight increase in numbers of transactions coming forward in future months. We're continuing to recruit agents very well. We think that we've got a compelling offering to them, and that's shown in our strong recruitment numbers. And we're obviously concentrating on building that market share from our circa 1% at the moment. Our strong financial position, we've built now a financial position, a balance sheet that puts us on a very steady platform to go ahead with the inevitable consolidation of the industry, which we would like to lead. We think our business model allows us to do that, whereas the franchise model doesn't necessarily lend itself to that. Thank you. Just a very quick slide on the structure of our shareholding. You'll see there 30% is Peter's investment, our major shareholder. They also hold a $3 million convertible note. Daring Investments at 5%. We're a founding shareholder. Directors and management hold 8%. Founding agents, healthy 16% amongst them, and then a free float of 41%. Moving on to the management team, we do have a very, very strong and experienced management team. We're not there with that strength and attendant cost to be this size of a business. We've structured ourselves to be a very much larger business, and we've got the right people in the right place to do that. And we think that we're quite unique in regard to that. So we're well positioned again to drive further growth in the business. That's the end of the very quick presentation. I'd love to see if anybody's got any questions for me, please.
Thanks, Geoff. Just a quick question here on what's stopping other agents kind of replicating this model? I mean, the reality is people are working at home these days, so having a physical office is obviously part of your model, but what's to stop Ray White doing that and kind of copying this sort of model?
Yeah, and so the existing franchise structure of the majority of the industry, they've got legacy issues where they've got franchise agreements of 5, 6, 7, 8, maybe 10 years in place. And so it's very hard to turn those big ships around in a nimble manner. The other thing, of course, is if you go back and have a look at the capital that was invested in this business from the outset, there's a significant amount of capital that was poured into this, and we've only just got to a point where we're starting to cover over that and produce positive EBITDA. So there are barriers to entry. We do actually operate a secondary brand, which is a lower service offering, and that's for a different type of agent. And so we protect ourselves there by participating in that market as well.
And kind of looking forward 1 to 2 years from now, I mean, we're in a real sweet spot for real estate. What does the EBITDA and profits look like?
Yeah, so we don't issue guidance, and 544% year on year is pretty unsustainable, I think. But we'd like to think that we're going to improve our EBITDA. How's that as an answer? I gave you a figure before of 7% growth in agent numbers. They take a little while to become productive once they come on. We'd love to think that we could annualize that growth. And if you extrapolate that out, you can start to do some interesting mathematics.
And scale comes from bringing agents on board. Real estate agents move around a bit. How do you kind of keep a hold of those agents?
Yeah, great question. And so you'll recall that I was talking before about an agent-centric business. So we're able to actually, first of all, offer them a higher split than the majority of people. They simply can't do it because of their cost structures. And that becomes an even bigger moat for us as we get larger and there's more efficiencies. We also offer them a very efficient and supportive back end to get them out doing what they're doing. I guess an analogy is something like the old-fashioned hardware stores that couldn't compete against Bunnings. But just because Bunnings have got that scale, they also got the ability to actually be attractive to the customer through that scale. So I guess that's an analogy that we use.
And just quickly, the industry is cyclical. There's a question here. Is the model able to handle a slowdown of property? Are you protected with your rent rolls and those sort of things?
So rent rolls are important. We've got one of the larger rent rolls in the country. Again, a difference between us and the franchise business. The franchisors don't own these rent rolls. So we have an asset worth about $25 million, 3,500 properties. And if you look at the value of those properties, we're actually managing assets worth about $3 billion. And so that generates a nice recurring income for us to smooth through the cycles of sales. But of course, one of the best smoothers through those cycles of sales is growth in agent numbers. The market gets tougher. Agents look to come to a place where they can get more support. So we think we've built, as I say, a moat that protects us against that and positions us well.